In today's episode of Retiring Today, we'll talk about the 5 types of inherited assets and how they're treated, some of the tax rules that can help you or maybe surprise you, special considerations for spouses and non-spouse heirs, plus how to turn an inheritance into part of your retirement plan. Lauren, when people inherit an asset, sometimes they might feel pressure to act quickly, but that's when mistakes can be made.
Which is really understandable, because when you inherit an asset, inherently somebody has passed away, probably a loved one you cared a lot about. So you have the emotions that you're dealing with, but also there are certain things that you do that are timely that you have to pay attention to. And so a lot of times the investments portion of it will get pulled into those things you really need to act on. And in most cases, this could surprise somebody, but in most cases, you need to take a little bit of time before you make decisions on those investments, because some investment decisions are longer term types of investment decisions that you can't undo. So you need to make sure you have everything in order before you make those types of longer term decisions.
Yeah, we actually just saw an example with a family we just started working with where she inherited an account from her dad's workplace, and they gave her a 90-day window to get those assets transferred out within. So she's dealing with the loss of her dad, and now she's got to make some very serious financial decisions, and she's trying to figure out, well, what do I do next? Meanwhile, when she looks at those plans, she knows they haven't appropriately been split across beneficiaries. So she's in a spot where she knows she needs to take action, but on their end, they're not moving very quickly. And you can just see how challenging of a situation that can be, on top of obviously losing a loved one.
Yeah, and what we hope today's episode does is help you feel more confident and informed when this happens to you. So one of the first things to know about is taxes and some of the tax rules, Lauren, because I think I've heard people say they're really worried about the tax implications of when they inherit something, but it's good to know that those federal tax exemptions don't really apply to most people.
To most people, the federal tax exemptions wouldn't apply. A lot of times people will come to us and say, a loved one passed away, I'm going to inherit some money. What is the tax implications? Well, we can't stop there. We have to really dive into what type of money did you inherit? What type of asset did you inherit? What types of accounts are they in? And also you have to consider the state that you're in, because there's a lot of state differences when we're talking about these taxes. And we also can't just stop at taxes, because there's different types of taxes. There could be, depending upon your factors, income tax, could be estate tax, could be inheritance tax. There's a lot of different types of taxes we need to consider and plan for.
Yeah, here are a couple of facts. So the federal estate tax exemption is $13.99 million. That's for 2025. As far as state taxes go, they do vary. 5 states impose an inheritance tax. They're Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. Maryland is the only state that charges both an estate and an inheritance tax. So let's talk about, you said it varies by asset. So what we want to do is talk about the 5 types of retirement assets and how they're all treated. So number 1, let's talk about cash and taxable accounts.
Yeah, in a lot of ways, inheriting cash can be one of the simplest and easiest. But what happens in many cases is they're closing down an estate. They might want to keep that cash back and not pass that on until much further down the road. Sometimes that's the last thing to pass on. So with cash, you can make some new investment decisions with that. You can keep it in your bank, but that's something that's typically not going to have any sort of tax associated with it unless there's been growth and interest on that account since the date of passing. But cash can typically be one of those more simple and easy things to inherit.
Number 2, stocks or mutual funds. What do people need to know about this?
The way that stocks and mutual funds are inherited, we're assuming here they're outside of IRA accounts, is you get what is called a step up in cost basis. Just a quick example. Let's say you inherit XYZ stock and you inherited it from your grandma. Grandma bought XYZ stock at $100 a share, but now XYZ stock, when she passed away, is worth $300 a share. You do not pay taxes on that $200 per share difference, the step up in cost basis, which means you don't pay taxes on inheriting that stock. Now, if you hang on to that stock before you sell it, let's say you hang on to it for a year and it appreciates, you will pay taxes on that appreciation since your grandma had passed away. But as of the date that your grandma passed, that is tax-free asset to you. Same thing with mutual funds.
And one thing that we always talk with families about is sometimes they have an emotional attachment to some of those investments. So that's always important to walk through and just help them see, is this the best thing for you to continue to hold that stock, or would maybe there be something different or something better? But sometimes that stock that grandma had and she grew for so many years, that has an emotional attachment that sometimes families like to hold on to.
Especially if you've had conversations with your grandma about that particular stock. One of the common things that I can think of is Disney. Grandma held on to Disney stock for a lot of reasons. Maybe she got a discount and you were taking Disney trips with your grandma, so you have that emotional attachment. That's fine if that's one of the reasons you want to hang on to it, but also make sure that it does fit into your overall bigger picture.
Asset number 3, retirement accounts. We're talking about IRAs and 401ks. What do people need to know about inheriting those?
This is where it starts to get a little bit more complex. With an inherited IRA, that's something that under the Secure Act rules, individual that inherits it is going to have a 10-year distribution window. Well, they are going to have those dollars out and the tax bill paid within that 10-year time frame. If they inherit a Roth IRA, the 10-year rule still applies, but they do not have the tax that they will receive on those dollars within that Roth account. So they can keep that all the way for 10 years, or they can take some dollars out year over year, depending on what they so choose.
But hang on there, Clint. That's if you're not a spouse. If you're a spouse, now you have different inheritance options. In fact, you can move that money into your name underneath your IRA or your 401k plan in many cases, and then you can just treat it as if it's yours. So you're not mandated to take distributions out within that 10-year period of time. Or you could have the option of moving it into an inherited IRA underneath the name of your deceased spouse, which gives you some different distribution options. And the decision on which one do you do is all dependent upon many factors. How old was your spouse? Was your spouse mandated to take distributions? Are you younger than what your spouse was? A lot of that goes into it. We have to look at all of those, review all of those prior to those decisions.
Asset number 4 we want to talk about is real estate. So we're going to compare and contrast. You inherit some real estate from a loved one, you hang on to it, versus if you inherit the real estate and you sell it right away. So here's the setup for what we're going to do. We've got Patty. Patty inherits Grandpa's house. Here's some facts that you need to know about Grandpa's house. Grandpa Joe purchased the house at $100,000. He purchased the house March 15th of 1980. Grandpa died August 1st of 2024. The fair market value of the house is $500,000. Patty inherited this house. So let's say, Lauren, first, you've got our first scenario. Patty, are you doing sells quickly, sells right away, or hangs on to it?
She's gonna sell as soon as she can.
Okay, so she sells as soon as she can. What does that look like?
Yeah, so what this looks like is Patty, a lot of times will have to clear the contents of the house. So many times they'll have an estate sale or just move stuff out of the house. And then she has to, the estate has to be ready for her to take ownership and then sell it. So let's just say a year after Grandpa Joe passed, she decides to sell it. The market value over that year did appreciate. So it went up from $500,000 to $510,000. So she might think she has a little bit of tax on that appreciation. However, we can consider the selling costs associated with selling that house. Let's just call it a conservative $20,000, which now means she does not have a gain. So in essence, she will be able to sell that house for whatever she sells it for, call it the $510,000, and not have to pay any capital gains tax on that sale.
Okay, and then what happens, Clint, if she waits to sell the house?
Yeah, what if she decides that she wants to keep it around a little bit longer, just kind of can't make a decision, and then over that time period, let's call it 6 years, let's say that home value, that market value goes up from $500,000, which it was when her grandpa passed away, it now goes up to $700,000. Well, you could see that she's going to owe some tax on the capital gains within that, and she can still deduct some of those closing and different costs to repair to get the home ready for sale. So she's going to be able to have $170,000 that she shows for capital gains. That will be taxed at 15%. So she will have a $25,000 500 tax bill that she will have to pay on the gain of that home that is appreciated in value over the 6 years from when her grandpa passed to when she decided that she was going to sell it.
So she could pay somewhat, you said $25,000 in capital gains tax?
Correct.
Okay, so as people, if they inherit a house, someone watching says, hey, my parents have a lake home, I'm set to inherit it. How do people decide whether they sell right away or hold?
Well, there could be some sentimental value, especially a lake home. Maybe they've been going up to that house many summers and they want to hang on to it. Maybe they want their kids to experience that same type of thing. There's a lot of reasons emotional reasons somebody might want to hang on to it. From a financial standpoint, one of the strategies that they can incorporate in your example, Clint, where they do hang on to it, in this case 6 years, is they can convert that to their primary residence. And now, once they go to sell it, as long as they've lived in it for 2 out of the last 5 years, they can, based on their filing status, married or single, not pay taxes on $250,000 up to $500,000 of that gain. And that could be one reason why Patty decided to hang on to it. She wanted to actually move to Grandpa Joe's lake house for a couple years, experience the lake full time, and then she can sell it virtually tax-free.
And is the takeaway, if you know that it's a home you don't want to live in, to try to sell it in less than a year, than as opposed to hanging on to it for more than a year?
With so many of these decisions that somebody has when they receive an inheritance, that's where your plan really starts to come in to full view. Does that fit within the lifestyle portion of your retirement plan? How does that look from an income perspective? Do you want to try to rent it out and make money on it? From a tax perspective, how does that fit? So these are all decisions that you just want to make within the context of your overall retirement plan. And then obviously considering the sentimental or emotional factors as well.
And we talked about that a lot of these rules of inheriting change if it's a non-spouse versus a spouse. And if you sell this within 2 years of your spouse's passing, that changes the game, right?
Yeah, that does change the game, because then you qualify, or could qualify, for that exemption, meaning $250,000 or $500,000 of otherwise capital gain that you don't have to pay taxes on. And if you're not living in that house for 2 out of the last 5 years, that exemption goes away.
So I feel like too, it not only what you inherit, it's who you inherited from, and the rules are different based on all of that.
Yeah, and in some cases, you might want to sell it, or you might want to use it or do something with it, but it could be tied up in the probate process. So this gets to that importance of having some of those estate planning documents in order. There's a family that we work with a couple years ago. Their family had their dad passed away, and then he passed on a farm as well as a farmhouse to his kids. And then he also had a house in Florida. And that house in Florida was not incorporated within the trust that they had. So then that house had to go through the probate process, which took 18 months plus in the state of Florida. During that time, the home actually got hit by a hurricane. And so they had a really challenging time getting in to fix the house, getting people to work on it, because their name wasn't on the deed. It was still tied up in the probate process. And that became a very cumbersome house to inherit and try to figure out what to do with it next, still maintaining the market value that it had when her dad passed away.
Yeah, and that's a pity, because he went through the work. He went through the work to create the trust, incorporate all this other stuff into that trust. He just forgot this house in Florida, where it could have been a transfer within maybe 3 months, and then they could have done something with it prior to the hurricane. It's just, these types of things have to be considered, because one little thing can turn into a big thing if it's not considered appropriately.
Asset number 5, life insurance and annuities. And I know this one gets really complicated and really nuanced, but if someone inherits these, what should they know?
Yeah, if they inherit a life insurance policy, as long as that's paying out in a lump sum, not any sort of installments, then that's something that they typically are not going to have any sort of tax associated with. Annuities are also an insurance strategy. Those can be more complex. So that's something that you definitely want to make sure that you have your plan together. You're working with a retirement planner to help you see what the different options that you have are, because some of those assets we talked about earlier, like an IRA or a non-qualified account, the rules change when that's now bound within an annuity contract. So those are things you want to make sure you understand what your options are and see how that best fits within your plan.
We've got number 6 here, personal property. So of course, this could be furniture, clothing, and jewelry. What should people know about inheriting that?
It's not very common that we do find tax consequence on the personal property items. Every once in a while, there could be a collectible you want to hang on to, and it appreciates quite a bit, and then you sell it. There could be some tax consequence on that. But the most important aspect is take inventory of the personal property that you do have. Take a market value estimation on the property that you want to get rid of, and then that will go into your calculation. And everything you hang on to at some point down, a lot of times people want to pass that on to to their kids, and that market value will just continue to go down the line.
And that's something important to remember is keep track of any sort of repairs. If you do inherit real estate, for example, if there's repairs, keep track, document that, because that will be things that you want to incorporate into what sort of gains you might owe later down the road as you're working with your CPA to file taxes.
Yeah, that's a great tip, Clint. I was thinking about this too, as far as not only if you inherit it, but the viewers, that people that are watching might be thinking about their legacy. They might be thinking about passing things on to kids, grandkids, sisters, brothers, nieces, and nephews. So as you help people set up legacy plans, how do you tell them to pass on their assets? What tips do you give?
We have to be really intentional. A good example, we just met with an individual who she's setting up her legacy. She's confident she has enough money for her retirement. Now she's thinking about what does she want to do when she passes away. She doesn't have any kids, but she does have some meaningful charities she wants to help contribute to, and then she has some nieces and nephews that she wants to leave some money to. So when we organized her legacy plan, we were very intentional. She has some tax-free assets like a Roth IRA. We want to make sure that Roth IRA doesn't go to the charities, that goes to the people, her nieces, her nephews, because when they inherit that Roth IRA, they're not going to have to pay taxes on it. If it went to the charity also wouldn't have to pay taxes on it. But if the nieces and nephews inherited the traditional IRA that she has, then they're stuck with that 10-year rule. They have to have it distributed within a 10-year time frame, and they have to pay taxes at their ordinary income level on that money. So just a quick flip in itemization of here's the assets you have, here's the assets you want to pass on, and here's the tax consequence. Let's make sure that the taxable goes to the charities and the non-taxable goes to the people.
And Lauren, that Secure Act really changed the game when it comes to inheriting pre-tax money, where now you've got that 10-year distribution schedule. Previously, families could stretch that out across their lifetime, and so maybe that's what they've experienced or heard of in the past, but they need to make sure they're aware that if your beneficiaries are in their highest wage earning years, and now they've got 1/10 that they have to stack on top of their income year over year, then they need to make sure they're prepared for that. And you're thinking about that as well as you're starting to title beneficiaries and thinking about what different rules are in place that you need to be aware of.
And that's one of the considerations that we take when we're making people's tax plans. Because if it makes sense from a tax standpoint for them to do something like a Roth conversion, then that will also help their legacy on sending that to their kids or nieces and nephews or whatever people they want to send that money on to. Whereas if the kids inherit the pre-tax money, it's taxable. They inherit whatever's left over from the Roth, then it goes to them tax-free. So there's additional benefits that can come from the tax planning in the form of the legacy plan.
And like we talked about, those deadlines are important. We talked about that example of an individual who inherited a work plan from her dad, and they gave her a timeline for you need to have these dollars out within 90 days. If she doesn't meet that deadline, that's likely to push everything out in a lump sum. She would experience the tax on that all in 1 year.
This is Retiring Today, and we thank you for watching.
Thank you for watching. If you enjoyed this, click here for another video. Be sure to subscribe to get more engaging retirement planning content.